Hey guys, welcome back to another conversation with the stalwart of Indian institutional equities ecosystem, a man who needs no introduction and who also recently served as the CEO of Nirmal Bang Institutional Equities. And he's been there for over nearly 2 decades. So a man, like I said, who needs no introduction, Mr. Rahul Arora, someone who I've been watching on news channels and really aspiring to be aspiring to have a contribution like him. And today it's really like it's like really like it's really like my bucket list checklist where I get to speak with him. As you can see, I'm always also slightly nervous. This never happens, so I'm very excited to have this conversation with him. So good morning, Mr. Rahul. I think, yes, we can begin this conversation. I think I'm just a little bit nervous speaking to you today.
No, thanks for having me, Sanjot. No need to be nervous. We're two of a kind.
Okay, okay. So, I'll start with, usually I think usually I try to make the guest comfortable, but today it's the case where the host is slightly, feeling a bit of jitters. So, I would like to make myself comfortable by asking some simple, questions with you. It's like, how did you get into finance? What got you into finance, and your, stint with institutional equities? How did that come into?
Honestly, Sanjot, I'm a big believer in destiny, and I think sometimes what you seek out and what seeks you out can be two completely different things. I'm a kid who's been born and brought up in Bombay. My parents were born and brought up in Bombay. I did my schooling in college, junior college in South Bombay before I moved to the US. And then in my senior year, I graduated a semester earlier. I took some extra credits. But little did I know that when I was planning to graduate a little earlier, that something like 9/11 was waiting to happen. And I graduated literally in December of 2001, and 9/11 had happened just a couple of months before that. So it was a very, very tough time for the
Right.
global economy as a whole. Obviously, financial services was not immune. And this obviously, was juxtaposed to the entire dot-com crisis that was happening at the turn of this century, which started, around 98, 99 and worked its way into 2001 too. So the world was not the happiest place for those 3, 4 years, so to speak. India itself was just coming out of sanctions being imposed on it because of the nuclear tests that we had done. It was just a question of after finishing my graduation in the US of literally taking my resume and going and meeting as many companies. A typical Bollywood kind of story where you board the buses and trains and you're trying to meet as many people as possible and trying to see what's best that's out there. I think for me, Citigroup happened just by chance in Chicago. It was, like I said, it was not something that I had set out to do. I was
Right.
open to doing anything. I had interned with Solomon Smith Barney and a couple of other firms during my undergraduate days. But it was, as they say, the world is your oyster when you're graduating, and you just feel that you could do anything at that point in time. You were entering a new century, and you felt that the future belonged to us. But you were hit by two, very gigantic events. But I think it was more destiny than anything else. I think my first job sort of found me as opposed to me finding it because it was one
Mm.
of so many. Of course, from there on, it's been a bit of a whirlwind. Even today, when a lot of young students ask me, or tell me rather that they don't know what they want to do in life, I say that's okay. I'm 45. I still don't know what I want to do in life. As my next step. So sometimes life just happens. I think you just have to roll with it. Obviously, because there were visa restrictions, post graduation and the amount of time you could stay back in the US. My move back to India was a bit of a forced, relocation.
Right.
And then things just happened. I think for me, PwC corporate finance was my first job back in India. That was, got along the same lines as I'd got my city job in the US. It was just the same, thing done in a different country, moving around with your resume, meeting people, in all kinds of industries. So this was pretty much the first thing that fell into my lap and I took it. And then from there, UBS
Mm.
happened, CNBC. I never thought I'd get into media. It was,
Right.
the,
Very
the,
true.
the craziest thing I've done in my life is to leave a stable financial services job and enter the world of media. And to my last stint, as you mentioned, I think, these guys were pretty much, they were advertisers on my channel actually, when I was
Okay.
the editor of Bloomberg UTV, and they were looking to set up an institutional equity shop. And, it was just a byproduct of a conversation. It was like, क्या तुम कर सकते हो? And I was like, चलो try करके देखते हैं. And
हाँ.
the rest, as they say, is history. And 15 years have just flown by in the blink of an eyelid.
Insane, insane. So, in this, I want to ask, slightly, introspective question. Is it that, we should let go of the macro and really control the micro, or how do you look at when it comes to decision making? Because, that's where you said that, you don't really stress about the bigger stuff.
No, I don't think you can divorce the two, Sanjota, and I'll tell you why. I mean, see, there are countries that have very high taxation. There are countries that have no taxation. There are countries that you can work in and that pay you in dollars, even if you're not studying, even if you're not working in the United States. So these are macro factors, right? So I think you can never divorce the macro from the micro. The micro, of course, is what you study, your specialization, what you want to do, and what you want to make a career out of. But you cannot be divorced completely from the macros. Obviously, the economy of the country, is the economy of the country in good shape? Is there any financial or technological crisis? Is there anything happening in the banking system? Is a particular economy on the cusp of a multi-decade growth? I think these are questions that you have to ask yourself before you take a decision of what you want to do and where you want to do. I still think, regardless of what's happening in the world today and getting more inclusive because of what the United States is doing, I still think we're in a fairly globalized world where we can move around fairly freely and work where we want to and choose the career of our choice. But I don't think you can very easily divorce the micro from the macro, because there are various governing factors, like I said: growth, taxation, salary, how you're paid, quality of life, if you're married with kids, education system. And then it comes down to marrying it with the micro. What do I want to do? Which industry? What is my growth rate? What are my aspirations? So on and so forth. So, like I said, I don't think you can divorce one from the other. They have to go hand in hand.
Fair, I really love the answer. And on that, just want to continue on that front, within this journey of yours, would you like to, share some mentors in your path, or, someone who really helped you throughout?
Well, there have been quite a few people, some that I have met and some that I have never met, that I have imbibed a lot from. I think when you speak about leadership, and, I think the first person that I was ever inspired by, from a leadership perspective when I came back to India was Saurabh Ganguly. I think, he took over the captaincy of the Indian cricket team at probably one of the worst times in Indian cricket history, when you were hit by the match fixing scandal. Nobody wanted the captaincy. And this man comes in with a totally different attitude and creates a team that landed up going to the 2003 World Cup finals. And, within 2 or 3 years, the whole dynamic and the fabric of the country changed. I think that had a huge impact, on the psychology of people, the way they think, the Indian mindset. I think it may have even impacted a lot of business leaders. Because if you see the bull run that actually started in India, I'm not in any way saying it was linked to that, but it actually
Yeah,
started a year after, in 2004, and then went on to 2009. And some people
right.
still call that the best bull run that India has ever seen, the last 4 or 5 years notwithstanding. So I think Saurabh and the way he went about his business was very inspirational. I think another, person that I had looked up to from, managing my conduct, behavior, and particularly my body and my mindset is Novak Djokovic. I think probably, the discussion
True.
often happens whether he's the greatest tennis player of all time. I think the discussion often will be whether he's the greatest athlete of all time.
Right.
Knocking on the doors of 40 with that kind of a body and still making the semifinals. I think these two, even though you've not met them, if you've just followed them, they've had a great story to tell and inspired generations. I think in my own personal journey, I think a couple of people that I've really looked up to, one was Ronnie, who was my boss at Bloomberg UTV. The way
Right.
he went about business, the way he corporatized the movie industry. After he came in 2007 was a year of reckoning for Ronnie in many ways, and the way he conducted his business. My boss at UBS, Manisha Girotra, the way she conducted herself, and the aggression that she brought to the workplace. I think that was something that I really looked up to. And someone who's married charity as well as achieving very high success in financial services, a gentleman called Amit Chandra, who was also on the board of Tata Sons till very recently, the chairman of Bain and Company. So there have been people along the way that I've looked up to, but none more so than my mother. I can tell you the way she has brought us up. She's been a teacher for the better part of 50 years. I don't think, the values of humility, of, not harming anyone, to do right, to stand by what is right, even if it means upsetting people. I think the virtues that were instilled in us by our mother, I think there has been no bigger role model personally for me I mean, since I have been born, I've had probably the best one in my house. But beyond her, I think the other three or four that I listed to you from different fields of life, I think have been fairly inspirational in my journey to where I am today.
So, I've always, looked at your interviews and always, loved the approach that you have in terms of, the way you structure questions and the way you answer, even your research for that matter. But of course, I also do understand that, there were a lot of, experience that went in. So early on when you started off, as an analyst or as a, associate or, senior manager, during our years, what are the kind of, learnings you had? What the kind of, absorption techniques you had? Or of kind of really trying to get better at what one does?
So I think Sanjot, this is a very interesting question because I have no form of postgraduate education, which is a very big handicap for a lot of people in the financial services industry because you have CAs, MBAs, CFAs, and some of them do a cocktail of them today and are very hardworking people. For me, when I came back to India, it was a call between getting into the industry or doing an MBA. And at that point in time, because my parents had spent for a US education and it was a forced relocation back, I don't think MBA was an option for me then and then overseas. Within India, I must confess, I gave CAT, I gave CET, I gave XLRI. Some of these I did well, some of these I did horrible. But I got a call from nowhere.
Right.
And then I did apply to ISB. In fact, my essay for the Indian School of Business on Leadership was
Right.
written on Saurabh Ganguly, and I remember the interview was at Taj Lands End, in terms of my group discussion. But I think the one thing that helped me, despite having that quote unquote handicap, I don't really call it a handicap. It's just it's a handicap in literature, was reading a lot. I think I spent a lot of time with my seniors in most workplaces, whether it was PwC or UBS, understanding how to read balance sheets, trial balances, cash flows, understanding how these were made, meeting managements, trying to understand the kind of questions they were asking managements in terms of capital allocation, promoter intent, succession planning, just reading a lot of books, finance related, educational related, reading a lot of books about the economy. I went back and studied or read some of the books that, I had sort of had to, go through during my economics 4 years in the US or other 3.5. So a lot of those things helped me a great deal. So it was basically a lot of reading and a lot of long hours. I think the one thing I tell people today, because you're in an age of Instagram and, instant gratification, I think concentration levels are shrinking. But
Right.
I tell people that if you're ready to put in the hard yards at the start of your career, the rest of it lands up becoming sort of very easy. And I think the one thing that I learned the most observing a lot of people who I did not mention to you in terms of mentors, but there were a lot of people that I worked with that I saw did not know how to manage people. A lot of promoters, a lot of managers that absolutely had no clue how to manage people. And I learned from their mistakes and said, look, this is not what I am going to do when I'm in a position of leadership. I'm going to make my set of mistakes and my fresh mistakes and have people observe me. And tomorrow, when they're in my position, they don't make the mistakes that I'm making. So it was a mixture of hard and soft skills, but a lot of observation, a lot of reading, a lot of seminars. I would try to reach out to as many people, make as many cold calls as I could, and just go spend time with people, understand their journeys. And I think, 25 years hence, I think a lot of that has helped me, has put me in the right place, has helped me in good stead. And I think while I'll always have somewhere that regret at the back of the mind that I probably didn't do an MBA, I think, I don't see it as a handicap anymore. I think, a lot has happened in life. And I think not only have some of those hurdles been overcome, but even today, so till I was the CEO at Nirmal Bang Institutional Equities, we were not doing anything with respect to any educational institute of any repute. And I started giving a lot of talks, to educational institute. We started branding ourselves with the CFA society, and we did a lot of, we used to co-sponsor their annual flagship conference. So these were initiatives that I brought to the table because I believe education, there is no substitute for. And again, it goes back to the point of being the son of a teacher. So I think in some respects, so I think some of these things in my formative years helped me a great deal. And, it may sound a little funny to you, but I still have a lot of those textbooks with me even today. So if I have to go back and visit those concepts, I go back to things that I studied in university even 20 years back and say, okay, let's just revisit this concept, whether it's microeconomics, macroeconomics, or whatever.
Right. So in this, like in the past 25 years, we spoke about, promoters, we spoke about a lot of things. What are some things that, promoters still do wrong and in terms of managing people or in terms of businesses? And what is it that has changed in terms of courses of business, in terms of, listed or non-listed entities?
So I think a couple of things. I think the one thing promoters have become increasingly cognizant of is capital allocation. And I think, if you look at corporate India as a whole, the one thing that changed post-COVID was balance sheets were delevered. And I think that was a very, very important and seminal moment in corporate India's history where, you suddenly had a situation where you had companies that were going in that were on a sticky wicket, high debt, patchy cash flows. A lot of that was repaired. And I think, people have learned that lesson. And it's been 3 years since COVID has been over, 2022. We're sitting in 2025. I think that discipline, by and large, has stayed. I think, I still don't think India is a very employee-friendly country in terms of the policies. I still think most managements and promoters get it wrong when it comes to dealing with people. And I think it's because their mindset over a period of time has not evolved in terms of how they need to deal with the next generation, how they look at money, how they, reward people, how they approach concepts of leaves, while ladies get 6 months of pregnancy leave, what happens to the guys who also would want to contribute as, in terms of being a father. So I think a lot of the softer skills, I think there is still a long way to go in terms of where India is compared to the rest of the world. But I think the biggest positive that has come out of corporate India over the last 20 years that I have seen is corporate governance. I think a lot of industry bodies and governance committees have come together to serve as watchdogs. I think the rise of the voice of the minority investor, institutional or otherwise, I think board meetings today are taken far more seriously. Independent directors are taken far more seriously. Capital allocation today is taken far more seriously. Succession planning is taken far more seriously. And I think companies that are not doing all of these things right eventually are sort of, heading towards their own doom. But I think those that have got, that have cracked this mantra are the companies that are growing and will continue to grow. So I think from a hard skill point of view is how you manage the numbers and the maturity of it, and how you sort of, even reward shareholders. And from a soft skill standpoint, I think there is still some way to go in terms of how that disconnect between how an employee wants to be perceived vis-a-vis how a management wants to sort of, treat them. I think that disconnect still has some way to go.
Very, very interesting perspective there. And also, bringing the conversation slightly towards Nirmal Bang and, your journey over there. We spoke about, the CFA partnership and a lot of things, right? But in the past years, yeah, as long as you've been there, we went from a mid-tier brokerage to a top 10, research house. So what kind of strategic bets really played off?
So I think, Sanjot, the most important thing is, a lot of my colleagues over the years have told me that we allow a lot of freedom in terms of working. And I think that's a culture that I put in place the moment I joined. And I think because I was a very young leader, I took over this assignment when I was only 30 years old. I was a youngster at that point, so my mindset was that of a youngster. I was basically building a company with the value systems that I had received from, my home and my past mentors, and I wanted to carry that forward into this current job. So I think the one thing that we did off the bat, and I had told my leadership at that time, is to allow immense flexibility to the team in terms of whatever they want to do to succeed. If they wanted to go visit managements, if they wanted to go visit somebody's factories, plants, do channel checks, just let them do it. Give them the freedom to track stocks. Obviously, we will not track bad stocks, but give them the freedom to sort of identify new companies. We were very cash flow centric from the time we started in terms of the companies that we covered. We also scanned the market to see which stocks were being covered and which were not being covered. And if I take you back to 2010, there were so many of these companies that are larger mid cap or larger small or smaller large cap companies today that were not even being tracked 15 years back. We were probably the first to track so many companies that have become multi-baggers. I don't even know how many baggers some of them have become. But that gave us a tremendous first mover advantage in terms of identifying these companies and targeting those that our competitors was sort of not doing. The other was obviously investing in the right kind of people. Like I said, I'm a people to people guy. I invest personally a lot with the kind of people I work with. Relationships are extremely important to me, and it's not just about professional relationship. I always took it a step further into, getting into the personal lives of my colleagues and trying to, just be there for them whenever they wanted. And I think that builds a lot of loyalty. And I think, I don't know if you've seen Suits, but one of the most famous lines that Harvey Specter says is loyalty is a two-way street. You will get it from me if if you give it to me, I will give it to you, kind of a thing. So I think where people fail to understand that loyalty is a very expensive commodity. Not everyone can give it, but you have to create the environment for loyalty. So I think we invested a lot of time in hiring the right kind of people, identifying the right kind of stocks, the approach that we had. I think my media background helped me a fair bit, Sanjot, because we had access to a lot of managements as a result of that. The kind of companies that we were able to give institutional investors access to, a lot of our larger competitors were not able to do at the time. So these were a lot of things that opened up. We were, I remember when I set up, we were hit by a regulation very early in our career where brokerage rates were, when we got empaneled with a lot of funds, they were paying us 25, 30 basis points on cash. Overnight, SEBI came in at one point in time in the very formative years of our setting up and said that the cap would be 12 basis points. So we saw that, realizations collapsed by half pretty much overnight. And, we had to contend with that. But I think the one quality that my team always showed was tenacity. I think we were very persistent. We were a bunch of young group of people who collectively wanted to make a mark. And I think, Sanjot, the most important thing that people need to realize when when you're working in a company is no one individual does anything. I cannot stand here and take credit for anything that Nirmal Bang has done over the last 15 years in my individual capacity. It has been a collective effort of every professional that has come in and worked with us and has contributed in this journey. I think if any CEO or professional or team member or promoter believes that it is because of them that a company is working, that is about the most regressive mindset that you can ever have. So I think, you have to believe you're a part of a team, develop the right culture, and hope that, in that culture, if you're able to give freedom, the team thrives. So I think it was, again, a mixture of hard and soft things that we did that helped us succeed.
Fair. So in this time also, in this, during your stint, were there any like counter consensus calls that paid off, that went?
Yes, actually, two come to my mind straight away. One was a call that we took not too recently, where we had a very heated internal discussion when defense as a sector was doing really well. And I remember we had initiated on that at NBIE, and within, I think, 3-4 months of it, if I'm not mistaken, the stocks had doubled. It's not like they had doubled because we had initiated. They were already doing well. So they had already had a good run before we had initiated. And I think from where we had initiated, the stock had doubled. And, human beings have a recency bias, right? So everyone was like, ye to badhta jayega, ye to badhta jayega. It's like being on a fast train and, the brakes are off. But I remember having a discussion with my, head of research and my analyst, and I said, look, we need to downgrade this sector. I remember, and if she's watching this, she will agree to the fact that she was not so much in favor of downgrading the sector, but through a consensus call between the three of us, we decided to downgrade. And I think we were the first and the only people to downgrade that sector. And it corrected very sharply. In fact, stocks fell 50-60% after that. I ascribe a lot of it to luck because, you can try and do these things from time to time and they work out and sometimes they don't. But that was one that comes straight to mind. The other, I think, was my previous head of research, not Krishnan, but Girish, who was before him, had at one point a very strong anti-consensus call on IT. And that had kind of worked out pretty well for us as well. So I think that was one. And there was a sub-segment in chemicals, I remember, which was oleochemicals. And we actually went in and identified a couple of oleochemical stocks before the market move happened. And said we should buy into these, and those stocks did well. So these are some that are coming to my mind off the bat, where we were very positive. And I think another one that comes to mind years back is a company called Dixon Technologies. I think when it had listed, a lot of people felt that the valuations that it was coming on were very rich. We were the first subscribed note out on Dixon. and the rest is history. I think again that stock's been a multi bagger over the years. Probably will head to a nifty stock at some point. But yeah, these are some examples that are coming to my mind off the bat, which were both positive and negative, anti-consensus calls at various points in our journey.
Also as a CEO, when during your stint, what kind of metrics mattered to you most? Were it like, client shares, execution volumes, or any analyst credibility? What was it that you looked for?
So first is intent. I think whenever, over the years, so I have set up multiple teams at Nirmal Bang Institutional Equities. But over the years, I've sort of, reduced my involvement in terms of direct hiring. So I used to leave it to my leadership. But whenever a candidate was shortlisted by them to hire, I always looked at intent as the first thing, in somebody. What is the hunger that he or she has? And what can they bring to the table? Because I know what I can provide in terms of a platform and in terms of exposure to funds and so on and so forth. The thing I used to always look for was hunger and intent. The other was how committed over a period of time that you only get to know once they come in as to how committed they are. You will always have people who want to run away when the clock strikes a certain time. You'll always have people who want to put in a little bit of extra effort. I'm not saying that just because somebody stays back in office, they're doing more work and, there are extra plus points for that. No, some people are far more productive working in a compressed. I mean, somebody can do a piece of work in 10 hours. That same thing could be done by somebody in 8 hours. So number of hours in office has never determined anything for me. In fact, if anything, we've been very flexible in the way we've operated, particularly post-COVID, in the way, we sort of mastered the art of hybrid, if I should say so, without actually having a hybrid policy in place. So I think one is intent, the second is commitment, the third is depth of research. So
Right.
it's not just about like you and I are sitting on chairs right now. Anyone can do the modeling, anyone can write a piece of research report, but has that person made the effort to, meet the management, meet certain X's of the company, whether it be an ex-CFO, ex-CEO, ex-marketing head, ex-distribution head. If it's something you can touch and feel, have they gone on the street to see how the touch and feel is doing? This applies predominantly to consumer and allied consumer sectors because it's very difficult to get to clients of pharma, IT, oil and gas, manufacturing, but anything that has a touch and feel. Have you met their competitors? To what extent have you spoken to supply chain? So these things stand out, materially over a period of time. And I think the last is the persistence because, Sanjot, we are in an industry, albeit services industry, but it is the craziest services industry in the world. Because there is no other services industry that gets paid the way institutional brokers do. Now, I'll try and explain this to you. Let's
Yes,
assume
please.
you've gone to an Indian restaurant to have a meal. Let's say you've gone to Copper Chimney, right? Now, let's say the guy gets you the bill after you've had a meal. And you say, okay, I'm not paying you for this meal right now. Over the next 3 months, I'm going to eat at different Indian restaurants. I'll eat maybe the same thing. But at the end of 3 months, I will decide which restaurant I have to pay how much to. Right. Chances are you'll have a signboard saying outside, you're not allowed in anymore. So most services industry has pricing power. Ours is something that doesn't. Most services industries can determine their product to a large extent. We have to even cater to what our clients want. So we have to do a lot of bespoke work. So it's not an easy industry. Recently, SEBI has put out a consultation paper that has spoken about commission rates perhaps dropping to as low as 2 basis points. I don't know if that's going to happen. Even if it's at a midpoint of that, I think plain vanilla standalone institutional equity shops will suffer a great deal because of lack of product diversification. But when you're operating in that kind of an environment, you want committed people. You want people who will go in with intent, with commitment, with depth. And then how you basically build your client relationships. How persistent are you in terms of getting that client, going deeper into that client, and getting more of a wallet share? Because our business, Sanjot, is predominantly on operating leverage. So if
Right.
I'm currently if my market share today is 2% with in the market, or 1%, if that 1% goes to 2% or 2% goes to 3%, it could be disproportionate in terms of my profitability because the costs are by and large fixed. Because our raw material is basically people, right? I mean, these are just certain points that we have sort of lived by over the years in terms of how we wanted to go about our business. I think, we've been to some degree successful. I mean, of course, it's over to the team there now because I'm no longer part of it, but more power to them. And I hope that, the franchise that we have collectively built over the last 15 years continues to do well.
I'm sure the culture that you must have imbibed would permanently stay for sure. I want to also understand that, do you think that such regulations is a way of, such introductions of new regulations is a way for, for smaller players to exit and give more opportunity for bigger players, and then the market consolidates to, more like a 3, 4 player or maximum 10 player kind of like a, situation. Do you see things like that way?
So I am per se not in favor of that. Let me be very clear, because I don't think consolidation necessarily means the right thing for an industry. I mean, why should a mid-size or a small-size player who's running an honest shop and a profitable shop not be allowed to flourish? Right? Why take away that right from them just because you can? I think it has happened in many industries. I think the last one that comes to mind is telecom, which consolidated in a very, very material way. But I don't think that just because, so I think one of the challenges that our industry faced, Sanjot, is we didn't really have an organized body. Like you have, say, Amphi, or you'll have an auto component body, or a pharma body, or you have NASCOM for IT. We never really had an organized body per se for institutional investors. And I think that's why, when these regulations hit, and consultation papers are put out, I don't know to what extent they are actually defended. I personally have not been part of these conversations or ever been invited for them. But I think, there is an impact that it could have on employment, right? A lot of kids today who are doing CA, CFA, MBA and see this as a career opportunity, what are you going to do? Because if let's say the top 10 are going to control the industry, and each of them, say, has a research team of, say, 30 people, you're talking about only 300 people being employed, right?
Right.
Or maybe 400 or 500. What happens to the rest of them that wanted a career? Right. Because this is a very specialized job. I mean, it's like Kingfisher. If you remember, a lot of employees who were, with Kingfisher and were not getting their salaries, they were asked, why aren't you doing anything else? And some of them said, our job is so specialized कि market में jobs ही नहीं है. It's not a typical sales or a marketing job. Some of these were engineers and very specialized, doing very specialized duties. So what do you do? So I think there is an employment angle to it. Of course, you can argue what if AI comes in, and that's a separate discussion altogether. But I think the more people you have and the more choices you give people, let the client choose who he or she wants to go to. Why should a regulator dictate, who or how many players should be in a market? Yeah, as long as there are no malpractices, right? If there are malpractices, by all means, penalize. If you've, found evidence of it, and, SEBI has been very proactive in that. I think you've seen, as we were coming out of COVID, there was one very serious issue that was dealt very aptly by SEBI at the time. But I'm not necessarily in favor of, just controlling the number of people because you can. I think you should allow the freedom of the market to let people thrive if they can, and let the client choose. Today I may be doing something a larger competitor is not doing, right?
Right.
And so that is why they come to me. So why take away that choice?
Hmm. 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 Yes, speaking about also, AI and, youngsters trying to specialize, let's take another scenario where we also, kind of offline once spoke about that. What if you give these, kids who are CFAs, MBAs, you combine them with slight of, 5, 7 years of experience, 30, mid 30s, and then you give them some capital which is easily available and some AI. What are your thoughts about that? Because there are a lot of youngsters coming up with funds of their own, who are pre-IPO placements, or some who are like, regular funds who are like PMSs. So what are your thoughts on youngsters getting into this?
See, I think AI is a good assist. If I was to use a basketball term, I don't
Right.
think it can be necessarily the thing that slam dunks you in. Now, I do understand there is a fair bit of algorithmic trading already happening. There are a lot of program trades that are already happening. There's a fair bit of high frequency trading happening, and a bulk of our volumes may actually be today determined by that, or will be in the not too distant future. But I think AI has a place, but I don't see AI taking over. So technology has already come into the broking field. I think if you look at our industry per se, you have something called direct market access, which is a platform that we offer to institutional investors, and that's something that has found its way. And commission rates on that are a little lower than what the current caps are permissible by SEBI. They pay about 5 or 6 bips, I think, as opposed to the 12 bips cap that's there. But I think so. That is so. I would differentiate technology and AI. right? So when you're talking about AI, you're moving into intelligence. Technology is a platform. So as far
Right.
as retail is concerned, if you look at, say, what players like Zerodha or Grow or Angel are doing, right? And if a couple of larger players with deep pockets come in, it could, sort of sound the death knell for a lot of plain vanilla retail brokers. That is a different matter because that's platform and technology, and you're competing on brokerage and things like that. But I think purely from using AI as a tool to invest, I have my reservations. So I think AI can write you a research report. AI can, take out the fine points of an annual report, of a conference call transcript, of anything that you wanted to. It may even be able to give you a comparison. But at the end of the day, let's say I am talking to a fund manager of a fund, and let's say he or she wants to invest 200, 500,000 crores in a particular stock.
Right.
AI supplements it to a point, but I think beyond a point, they would want my analyst to open up a model, show them the working, the past projections, what their inference is, how they interpreted cycles. So I think that human to human connect is extremely important to cross the finishing line. I think AI can take you to the finishing line. I don't see it being a tool that will help you cross the finishing line. I may be wrong. I don't know how how AI eventually develops, to what level of information it start talking like you and me and actually giving recommendations, because right now it is just collating information, collating recommendations, but not using its own brain to tell you what to do. It is an assembler of sorts. I am
Mm.
talking about that assembly moving into execution. So
Mm.
if a lot of youngsters today, if they are relying on AI to make their investment decisions, whether they are in school, college, whatever, early into their career, I would say tread with caution. Still consult a financial advisor. If there's somebody in your friends and family that you trust who's elder than you, who's done it for 10, 15, 20 years, certainly sound them off. I would not be someone who would recommend a youngster who's getting into the markets today to invest basis AI, use it as a supplementary tool, not as an investment decision maker, is the way I would look at it.
Now, speaking to, thank you. That's very useful and very helpful advice. And this would be a message. Of course, I would be more happy to amplify, because what's happening is these days everyone has these tools, and they feel that they have understood the markets, or they just program couple of bots, and they feel that experience as a human experience can be percolated to bot, and it can be easily replicable, or give it intelligence and it can be replicable. But so I would definitely use that as a narrative, and as a message to further amplify this. Now, speaking about, how do you then choose sectors? How do you choose themes? How do you look at, the kind of things that are upcoming, or something that will really connect?
So I think sometimes these just fall into your lap, right? And let's
Right.
go back to, let's say, defense, right? So it was a relatively virgin sector. Not, of course, some of these stocks were already listed, quite a few of them, but it did not really get the attention it deserved till the government of India actually decided to, start procurement within India, indigenization, what they call Make in India. So till that happened, nobody was talking about it. So it just landed in your lap. Sometimes the market presents the opportunity and you just have to go in and track it. Let me take you back to, coming in during the lockdown phase and coming out of lockdown. A lot of platform companies listed, a lot of fintech companies, a lot of consumer fintech companies listed, and a lot of banking and insurance fintech companies listed. And these were across sectors, right? So you had a Nykaa, a Paytm, a Policy Bazaar, and it just went on and on and on. I mean, over the last 5 years, Zomato, Swiggy, and it's not stopping. Even today, there are a lot of platform companies that are currently in the IPO phase, and a lot of these are probably not raising capital for growth. These are more offers for sale from the existing private equity investors because they want to exit. Finding a theme is not easy. Now, this goes back to the first point you asked me in our conversation, macro and micro. So what
Right.
is the world looking at today? It's looking at AI, it's looking at renewable energy, it's looking at a cleaner environment,
Right.
right? Now, these are three themes that potentially, by the time I'm in my 60s, will become huge in terms of,
Right.
and data centers will become huge in terms of size of industry, listed players, or whatever. You don't have too many ways to play that today. So you have to go into the privates, right? So you're
Right.
seeing a lot of deals happening in the private sector. These privates will eventually list. I think, a lot of these private equity investors, whether they're doing a seed round or they're coming in, there's a Series A, Series B, whatever it is, eventually will list 5-7 years down the line. But you don't have too many opportunities to play them today. You'll have a couple of them and then they get disproportionately priced. And it goes back to an example I gave you about Dixon Technologies, right? With every PLI scheme, the production linked incentive scheme that the government came in the electronic sector, there was only one player that had that scale and size, which was Dixon. So the stock just kept on going up. So sometimes you're spoiled for choice and the choices are very limited. And one stock or one company gets a disproportionate share of that and becomes bigger and bigger. Of course, even in that sector, over a period of time, competition has emerged. And that's why I'm in favor of competition. You can't really have just one or two players in every industry, so to speak. So I think in today's day and age, I think these are 3 or 4 of the biggest themes. You can identify them, you can write research on them. There is enough and more that's being written about it globally. But how do you transform that macro into the micro in terms of making it a money-making idea? Those options are very limited in India today. You may have a situation where you can invest overseas in these companies. I think by statutory limitation, you're allowed to invest $250,000 overseas in the US markets also. So I know people who invested in copper ETFs, for example. That's something that you can't do in India. And made a lot of money. So you can identify these themes and just find the place in the world where you can play those themes and put in the money. But I think within India, sometimes these just fall into your lap, as happened with a lot of these platform, new age fintech, digital consumer, digital companies, or defense for that matter.
I would love to take your bite also on the most latest situation of Lenskart, because we were talking about digital IPOs. So what's your take on that?
Well, let's see. See, I'll tell you what happens is I think
Not recommendation,
again,
but like
no.
not
So
recommendation, of
see,
course.
obviously, I think the one thing that the Indian investor has got very cognizant of since 2020, when they first started investing in a lot of these companies like Paytm, Nykaa, Policybazaar, etc., and many more of them, is we started hearing terminologies that we knew in India, we had heard of them, but we would never really relate to them. Gross market value, price to sales, client retention, market share gains. I mean, these are things that you started valuing these companies on. Eventually, people realized कि भाई क्या कर रहे हैं? We are actually Indians. We need profit. ROE, ROC देखना है at the end of the day. कितना margin बना रहा है? Is he burning capital? What is he doing with the money raised? And you saw, I think most of these companies that we have discussed went up 2-3x after their listing, made a lot of money, but then became a third or fourth or even a fifth of their highs. So even someone think like a Zomato, I think at the high was about $150-$200, came down to 40 and then went back. And this is the case with a lot of other companies, right? Look at the last high profile one that came in, which was Swiggy, right? I think the issue price was around 350. It went to, I think, 600, 650, came down to 300. And today is moving somewhere around 450. So I think there is a certain craze and a fancy when people come in, but if history teaches us anything, it's to not get swayed away by recency bias. Let things settle down. I think the only issue which has held its ground in recent memory has been LG. And there too, I think because they got the pricing right in when you looked at the valuations compared to a lot of durables and electrical players in India, I think they got the pricing on that right, and which is why I think the stock is by and large holding. But I think barring LG, it's been a bit tough, and I think it may continue to be tough for a lot of these people going forward as well. I think we'll have to wait and see what happens with Lenskart, but there's a lot of literature that's been spoken and written about. But I wouldn't want to hazard a guess. I think somebody told me on trailing numbers, it's trading at something like 200 or 250 times. I'm not so sure. Would I invest personally in them? I'm not so sure. I think if I have enough and more opportunities to invest where I'm comfortable and I know that my margin of safety is higher, I'd rather do that than actually go into these companies.
Fair enough. Also, speaking of more of these digital companies getting listed, do you see the way of Indian shareholding also getting changed? Because traditionally there were much more higher promoter holding kind of companies, but now they are getting more PE backed and PE is coming in or mutual funds coming or FIIs coming in. Like let's say for an Eternal, right? Eternal Zomato is now a large cap. But if you look at the holding, I mean, there's not much holding of the promoter. So do you kind of see this kind of a situation changing or the Americanization of shareholding that's happening?
See, as far as as far as India as a country is concerned, we are in the process of an Americanization of a lot of things. I think our equity culture, the way we are consuming shareholder activism, I think there are various aspects of what has happened in America, say 20, 25 years back, that is today happening in India and over a period of time as well. I think the one thing that's also happening, Sanjot, is, and I think Bloomberg even wrote an article about this, is that a lot of second generational, entrepreneurs that are coming in, or the sons and daughters of people who've established companies, or maybe the third generation, that may or may not have an active interest in the companies that they are, that their family businesses are in. They're creating their family offices and investing in the stock market. So they're more than happy to dilute their stake, raise that money, put it in a family office. Basically, the whole circle comes around, right? So you dilute your stake, you raise the money, you set up a family office, invest back in the market. So that circle sort of gets complete. So I think to that extent, yes, you will find that the diversification of shareholding has certainly become a lot more prominent because you've had a lot of quote unquote new age companies come in that are PE backed. Intuitively, they'll have a far more diversified shareholding than inherent promoter driven companies. But I think even retail participation has become so huge in India today. I think we spoke about technology and having everything at the drop of a hat on your phones, whether it's a money control app or a Bloomberg app or an Angel One app or a Grow app or a Zerodha app. All of these are there on your phone today. So trading has become so easy for these people, and you're doing it with the behemoths in the market. So I think to that extent, even retail participation has gone up quite substantially. The size of the mutual fund industry has become so big, Sanjot. It was 5 lakh crores when we went into demon. It's what 75, 80 lakh crores today. So I think obviously the mutual funds have a far bigger say and stake in companies today than they did say a decade back, because forget any other sector. Just look at banks.
Semiconductor industry.
Just look at, the biggest sector in India today is banking, right? If you look at the Nifty, it's what 35, 40% of the weight is banks. The number of mid and small cap, even large cap banks that are holding of 10% by domestic institutional investors. And if they are not doing it by themselves, they are probably collaborating with a sister entity. So maybe a mutual fund and an insurance entity of the same house are coming and taking an 8-10% stake in these banks. So obviously for a lot of other mid and small cap companies, this is happening. So to that extent, yes, shareholding is getting diversified and probably will continue to if the equity markets continue to remain as buoyant as they have been over the last few years.
So, I mean, how is it that, coming slightly to much more kind of behavioral and questions, how is it that, with such an access to information, there will be more volatility in stocks, correct? But having said that, there is still kind of volumes that have come down on a YOY basis. So I understand that brokerage business is more of like a cyclical business, but with volumes coming down, how do you see markets kind of overall going forward? Because still, I mean, right now the Sensex has very much well performed in the past 6 months, but still volumes are down. So what are your thoughts on that?
I wouldn't read too much into short-term volatility, Sanjot. I think the equity markets have had a dream run. Money making has been relatively easy across the board. I think last Diwali to this Diwali was the first time I think the index at the headline level was flat to negative. So I think incremental delta of flows will certainly get challenged, especially when you're coming off a year where the gold and silver markets did really well, gave you 40, 50, 60% kind of return. So now suddenly people are asking, if I was say 60, 65% in equity, do I drop that down to 50 and put in like 10, 15% incrementally into commodities like gold and silver? So I think asset allocation today has become extremely important. I think if you look at real estate across the board is also doing pretty well. Obviously, it may be a direct beneficiary of the stock market returns that people have invested there. But there's let's talk a market like Bombay. There is so much infra that has come up in Bombay. You're talking about the Atal Setu, the coastal road, the very famous Elphinstone Bridge is just shut for the Siveri-Worli connector. So a lot of these real estate prices have actually gone up when infrastructure around them has come up. The metro, for example, that has connected pretty much all of Bombay now and is reasonably functional. So property prices have also started to go up. So I think it's not so much about equities anymore. I think it's more about, and the other thing that we spoke about a little earlier, privates. These days there are so many seminars where you have young entrepreneurs in that age group of say 25 to 35 that are showcasing themselves, asking for capital, and there is no cap on the capital. They say you can give me as little as 5 lakh rupees, right? So if by giving 5 lakh rupees you're able to take a stake in a company and you believe in that, as opposed to buying a stock for 5 lakhs, now just imagine if one out of those 10 that you invested in actually clicks. Could it make up for the other 9 that don't click?
Right.
So I think it's a entire bouquet that you have on offer today between commodities, real estate, equities listed and private. And then, of course, we are Indians, right? By default, we'll have some amount of investment in fixed deposits and things like that, even though we may not need it and we know that the post-tax returns are nothing today. But just from a safety perspective, some Indian families, middle class, lower middle class, upper, sort of from the LIG perspective at the higher end, we'll have a lot of bank savings, we'll have a lot of post office deposits. So I think when you're looking at asset allocation in terms of where you are in your income stream, that has become equally important as opposed to just where equity markets are likely to go. So I would not, coming back to your original question, I would not read too much into this volatility dip right now in terms of volumes.
Mm-hmm.
I think, sitting from where we are, the Nifty is 26,000 today. At some stage, it will become 35,000. At some stage, it will become 40,000. I don't know when that will happen. The Nifty was at 7,000 at the peak of the lockdown. It went up to 27, 28,000. So you almost had a 4x return on an index in like 3 years. Obviously, the returns from there have not been as magnificent as the initial 3 years. But there are always periods of calibration in terms of price and time. But eventually, it will head higher once earnings pick up and the market is sort of aligned to earnings, I think.
Mm-hmm. Let me ask you some of these myth-busting questions that I always wanted to understand from you. So, what do you think when these days they say that sell-side research is kind of dying because buy-side is doing their own research? So, what are your thoughts about that? What's the reality?
When you say sell-side research
Is kind of dying out because buy-side is doing their own
No,
research.
I don't. No, I don't think so, and I'll tell you why. Because I think the job of the buy side is very difficult. You have the kind of IPOs that have come out over the last 5 years. You cannot not meet them. You may not invest in them. That's another matter. But you
Right.
cannot not meet them. So the kind of meetings that the buy side is doing, in terms of understanding these companies, they are somewhere. See, we are all human beings. We have 24 hours in a day, right?
Mm.
You work backwards, you have a certain amount, you sleep, you have a certain amount, you eat, you commute, your family time. There's only a finite amount of time that you have to work, right?
Mm-hmm.
If within that work you have to keep meeting managements, because that is also an obligation of being a fund manager, it is not possible that your primary responsibility is not suffering.
Mm.
When that happens, you have to rely on sell side. So I
Mm.
refuse to believe that sell-side research is dying. I think, if anything, it is getting more relevant
Right.
today because it is required to supplement the efforts of the buy side, right? Because if a buy side analyst or a buy side fund manager has to write a report, even if it's just a 2 or 3 page report on every company he or she meets from an IPO perspective in a week, they may, if they're meeting like say 2 or 3 companies a day, you're talking about at least 10 to 15 companies a week, and then there
Right.
is time spent making those. So somewhere your work will get compromised. So I
Right.
think the relevance on sell side, if anything, is only increasing rather than
Mm.
decreasing.
Fair. So also, has the obsession with quarterly numbers really kind of, made the markets very short term over the course? This is right after COVID, right? Even right now, as we see since last year, everyone's looking at more of the top line numbers rather than profitability right now. So has this kind of like, where does this go to? And is this market much more short term in nature?
See, I don't think this is ever going to change. I think the US is talking about moving to a 6 month reporting. I will not tell you who I proposed it to, but I was in media at the time. I think this was somewhere in 2010, where actually
Right.
I had proposed it to someone very senior in the regulatory framework 15 years back, that we should probably do away with quarterlies and just have, half yearly and annual results, because the kind of productive time people are spending in terms of identifying companies and ideas is going down dramatically when you're looking at quarterly earnings with a microscope, right?
Mm.
I feel really bad. Like, for example, my banking analyst, right? There are weekends on Saturdays where she has to deal with 4, 5, 6 banking results and conference calls happening. IT services do that; they bunch up all their results. I mean, where is the time for quality research? Right? If you have to analyze every con call, competitors con call, write reports, make client calls, write previews, a lot of clients will ask you to do everything in a customized format. So you're formatting things for them. Where are you actually generating ideas? Right? That's the question. So I think there is certainly a case. Now, the counter to that could be, are we removing transparency from the system? Could promoters become complacent? Could you get into a situation where there is some hanky-panky with the numbers? The knife cuts both ways. I don't have an answer. I can certainly make an argument both ways. But I think there is no way to get it down to 1 or 3. It's either 2 or 4. So it's either quarterly or it's semi-annually. It can cut both ways. But I think the way Indian markets are right now, I really don't think that it is going to get into a biannual declaration at all. And even if there is, it is in talks, I don't see it happening in the near future at all. It is counterproductive from an effort standpoint and an idea generation and quality conversation standpoint, because most of it is run of the mill. I mean, you'll have one, the day we are recording this podcast, we have a stock called Naveen floating that's up 15%. You will have an odd stock here or there that's really doing something on the basis of results, right? It's not going to be every stock reacting on every result. So I don't know. I mean, from an effort standpoint, I would love it if it's, biannually done, but there is an argument against it as well.
So will this be the same thing kind of you would propose if, let's say, I would say that what is the one structural weakness in the Indian capital markets that you wish regulators would improve or fix? Would you still go with this?
F&O, futures and options, to get it all down to cash. I think it's counterintuitive that 95% or 90% or whatever that number is of your volumes are F&O, but then SEBI itself puts out a paper saying that 90% or 95% of the people that invest in F&O lose money. Why have it at all? I mean, you were talking about short term.
Right.
It is so paradoxical. Investing in F&O don't go hand in hand. Now you'll say, okay, become a trader. But then if you're luring it and everything around you has made you so short term, in terms of thinking. I mean, recently, I think there have been some relaxations. I don't remember if they've been completely relaxed. But there was a regulation that tied mutual fund managers' compensation to some of the funds that they're managing, right? And they were going to be performance linked, right? Now, let's say whatever happened in the Middle East happened, whatever happened with Russia, Ukraine happened, what's happening in the US. How is a fund manager sitting in Bandra Kurla Complex or Lower Parel or Narman Point ever going to have the remotest clue about it? He or she is not. He or she is going to follow the news, but you're penalizing them by having them invested. I mean, now you would say that, but you took your investors' money. You're taking it in good faith, no? So I'm not. You can certainly have the lock-ins. I'm not against it, but let it be reasonable, is what I'm saying. When you increase all of this, you are by default, you have made your market very short term. It is not by design. So then when you say invest long term, it is all very counterintuitive to me. It doesn't add up. But, India is a land of paradoxes. And I think this is one of those other anomalies. Yeah, I think, it's I don't think, I mean, I have personally never done F&O. I don't understand why you would, go down a road of margin, leverage. Why do it? Why do it? Especially if it's not your primary source of income. Why do it? If you're somebody who's a working professional or has your business, why go down this? What is the maximum amount of money that people have made over the years, including the great Warren Buffett? Is it through F&O? I mean, even in India, I mean, if you look at some of the great investors that people look up to and, are revered, have they really made their money through F&O? It's just a question to ask. So if there's one thing you would ask me to change, I'd say go more cash. Actually invest in businesses, don't invest in stocks. I think, people have started calling them scripts, stocks, counters. They're not scripts, stocks, counters. These are businesses. You are taking a share of a business. You have to think like that when you invest. And if a businessman is taking a call that he or she is investing 500 crores, 1,000 crores in capital expenditure or making an acquisition, you have to be aligned. Your thought process has to marry that thought process. So I am personally against short-term anything. It's great for my business. Don't get me wrong. The more people churn, the greater my business is. But if I was to take the business element out of it and just think practically, the more your younger generation gets into it, the tougher it's going to get, because my habits are typically formed at a young age. Then it's
Right.
very difficult to reverse it.
Mm-hmm. Fair. Last couple of questions I have for you. One is like, which is a single macro indicator would you use, to trust equity direction, and which is the one would you ignore?
Wow. Ignore, I would say GDP. Trust, I would say interest rates.
Hmm. And let's say, tomorrow AI gets everything gets AI generated, right? What human skills would you feel would still be like the human separators?
That will separate humans from AI.
Yes, if everything gets AI generated or
The
assisted.
it's in the answer of AI. It's intelligence. It's
Okay.
intelligence. It's emotional intelligence.
Mm.
Yeah. So let's say the computers that we are on, if they tell you to put 1 crore in a particular stock, you're going to think twice, right? But if I tell you to invest 1 crore in a stock, your chances of believing me go a little higher, don't they?
Yeah,
I may
they
still go wrong. You may still lose money on my recommendation, but your trust
would.
factor will be a little higher than a
Yes.
computer telling you to invest, right? You can't change that. That's just the way it goes. You cannot change that. And I
Love that.
think the answer to your question lies in the eye of AI, intelligence, emotional intelligence, emotional quotient, how you reason with somebody as opposed to just reasoning,
Hmm.
right? So let me put it this way, right? Russia and Ukraine are fighting. Let's say two people are fighting. Both
Right.
sides know they have to end the war, right? So let's say Ukraine goes to Russia and says, let's end the war.
Hmm.
That's one way of saying it, right? But if you sit down and talk and bring in EQ and
Hmm.
emotional intelligence, EI, not AI, EI and
Yeah.
EQ into it,
Right.
then what could be resolved, right? As
Hmm.
opposed to a computer telling you, buy 500 crores of HDFC Bank. But somebody sitting there having a model open, history, what has the merger, how has the merger happened? Over what period of time will it play out? What could HDFC Bank be 5 years down the line? It's a very different conversation.
Hmm.
The answer lies in I.
Hmm. Hmm. EI. Love that
I would
new
say,
concept.
yeah.
I have one last question for you, right? So you meet a lot of, hundreds of fund managers, I'm sure, in this course of time. So who asked the most brutal, thought-provoking question? Would it be the FIIs or DIIs?
Uh, I think anyone who's investing money will ask tough questions. I think the one thing that FIIs ask more than DIIs is questions related to governance. And
Okay.
I think DIIs focus more on capital allocation and cash flows. I think that's the big difference. I think, you must have heard of the concept called ESG, environment, social
Right.
governance. So that
Hmm.
emerged globally. So I think they factor in a lot of other softer skills before investing, and those questions are asked. But I think a DI would not ask those questions. They'd be predominantly focused around capital allocation and about cash flows, as opposed to an FI who's probably asking a lot of, okay, who's going to run the company 10 years from now? How are you ESG compliant?
Hmm.
What governance standards do you have? So on and so forth. So I think that's probably eventually they may, if there are 10 questions being asked, I think three or four may be different. The balance 6, 7 will be the same, but I think those would be the key differentiating factors between an FI investor and a DI investor.
But I would like to ask you, I would like to, because of your last answer, I would like to add a bonus question. What advice or what kind of input would you give for managements who are small caps, micro caps, or, slowly going to small to mid in terms of, corporate governance, in terms of corporate actions, or in terms of disclosures? How to kind of, increase their visibility, transparency in a way to make it much
Okay,
more.
so it's a very broad question, Sanjot. I think I would say, in terms of transparency, disclose as much as you think is relevant for your business, but don't
Right.
over disclose, because it's that phrase in English: you give an inch, you take a yard, right? So you don't want to show that you're overly doing things for the investor, because at the end of the day, it's your business. You know best as to how to run it. You can certainly seek advice, but I think be as transparent in as much as you think people need to understand your business. I think the second is be very clear on capital allocation.
Right.
I would say if you're a smaller company, don't rush into diversification. I think give it time. a lot of companies today, and I'm not naming anyone, like let's say 10 years back, somebody was making only a washing machine or somebody was making only a TV. Today, everyone's doing everything. So if you're a small company, focus on what you're good at, make it of a certain scale and size before you diversify, into some other verticals. Be very careful on M&A. See that you're doing it at the right valuation and it's going to be generative from a standpoint of your investors, not just your thought process. If it's going to be, not something that's going to be generative, then don't do it. Again, it comes down to a capital allocation policy. Reward the people that trust you, through dividend payouts. That is another thing. And, don't let greed get the better of you. I think, I've seen so many promoters where, when the company is making money, they want to keep it all for themselves. Disaster, absolute disaster. That's not something that you can do. I think you have to reward both shareholders as well as your employees in terms of having taken it to a certain standing. So these are certain things that I would say are extremely important. Don't be, I would tell, especially for the next generation that comes in, a second or third generation, take your time. I think decisions taken with a calm mind are far better than just following a particular fad or a trend in terms of where to invest in. It's if it's something that's complementary from a backward or a forward integration perspective, do it. But I think if it requires a completely different mantra, I think sometimes just taking a holiday before taking a big decision is not a bad idea.
Right, fair. That's a good way to, end this note of our conversation. Thank you, Mr. Rahul, for giving the time. And I've always really, looked up to the conversation you had on TV, and this was really a great insight from you. Thank you so much.
Pleasure is entirely mine. Thank you, Sanju. Really appreciate it.
All right. Thank you. Good day.